Yeah, no, and that's sort of concept of the
I have a fancy.
Okay, good morning everybody and welcome to this finance meeting. Today we'll be looking at the quarter ending 31st of December. Before we start, just say karakia, tuia ki ranga, tuia ki raro, tuia ki waho, tuia ki roto, tuia ki peheri tangata, ka rongo te tau, ka rongo te ao, haumie, huie. And that is unite above, unite below, unite without, unite with them, unite as one. Listen to the night, listen to the world of light, and we now come together. So let's kick this meeting off. We have any apologies? I don't think we have any. We have no public forum. The agenda will be as published. There's no changes to that. I ask if there are any declarations of interest. There's none. That's good. We don't have any presentations. The minutes of the previous meeting have been circulated as part of the papers. But is there anything there that stands out for correction? If not, can I ask somebody to move second? Thank you, Kate. Second, Ellen, thank you very much.
Oh, wait a minute, get yours in apology. I left early, so I better not do the confirmation. Sorry.
Elliot, so moved Elliot, seconded Ellen, thank you very much. All those in favour, please say aye. Against? Good, thank you. There's no actions currently for this committee and no matters for consideration. So let us get straight into the quarterly financial report. We presented to the council. Welcome, Sarah. Sarah here? Nick?
No, it's just me.
Nick
Sean's online.
Okay, Sean.
This is just the finance report. It's not your report. Well, Mark's kind of it's not his report.
Nice, quite comfortable up there.
Okay, so we'll just hand over to you from that and take us through this.
Right, so we've got the cover paper, then we've got the three attachments, which is the we have SCREE breakdown, your comprehensive statement of comprehensive revenue and expenses, and then that's further broken down. It's got the capital expenditure summary in there. There's then the activity breakdown, which just gives you more detail of the high level that you see. Following that, there's the statement of financial position, so the balance sheet, and then a treasury summary that just gives you some more detail of those key treasury lines, which is our cash, investments, and our borrowing. But the key thing that you're probably more focused on is the overall council SCREE. And then the paper itself, we've tried to consolidate the summary and then do a couple of tables that gives you a breakdown of the variance at a surplus deficit level for year to date and then forecast. That we've combined the two because for a lot of areas, if there is additional or less revenue, it's very often offset by additional or less expenditure. So it doesn't have an impact on the bottom line surplus or deficit. So we've tried to explain it that way. But for the year to date, we are showing a surplus that is 3.4 million ahead of the budget. But then for forecast for year end, that is pulling back more in line with budget, but we're still forecasting that it's going to be ahead. And the key reasons for that, if you go to, and I sort of focus on the forecast because I think that's more important, is where we think we're going to be at year end, not exactly where we are at halfway through the year, because halfway through the year, there's a bit of timing in there of, we phase budgets evenly and some of the spend hasn't come through yet. But for year end, we're still forecasting that we're going to be almost 1.7 million ahead from a surplus point of view. there's almost $1 million of that is in relation to the managed fund gain. So for a lot of the forecast, what we do is we start where we're at with the current year-to-date variance, assuming that some of that can be locked in. We lock it in, and then we adjust the forecast for the areas that we think are going to move. So that year-to-date Treasury variance is just flowing through. There is a couple of areas, and we've sort of highlighted the ones in bold where we're changing where we're at for the year-to-date to where we think we'll be for the forecast. There's things like the land and water policy and planning. We're forecasting that we're going to be underspent there. So we're showing that will have a variance of 500,000. So extra surplus because we'll be underspent. Now we've discussed that and highlighted that through the annual plan for 25-26, because we will be carrying that variance, that surplus through, and we'll be using that to reserve fund some of the expenditure for next year so we don't rate again. You can also see we're forecasting that there'll be an increase in spend for the Lower Clutha flood repairs over the remainder of the year. So that will come through. Obviously, that goes into that flood scheme reserve and is deficit funded. And the other area where there's some things that we're still looking at is transport. Transport has surpluses, in deficits year to date. We have sort of amended them slightly, but we're still looking at the transport spend, and in particular the grant revenue that we'll be able to get, because there's still a lot of discussions going on with NZTA on exactly what they will and won't fund and what level they will fund to if our expenditure's going higher. So we'd expect that we'll get a bit more clarity on that for the next forecast in the next Finance Committee meeting.
And a couple of things to say. The couple of papers just reminding you that are to come. The Lower Clutha flood and drainage, we had a paper just before Christmas to approve us starting that recovery work after the October floods, but committed to bring a further paper next month, so the March council meeting, which highlights exactly, we'll know much more about that expenditure now. The team have been able to get on top of that and bring that full report through. So it was the repairs to the training line and all of the other damage from the October flood. So that's one paper that's coming that will outline a few of those matters. The other one to note is yesterday, so obviously the paper that Nick brought on the Rescue Helicopter Trust. We're now funding that this year, which is not currently showing here, but will need to be, will obviously fall into the next round of financial reporting. And just on transport, you'll appreciate in the current environment with public transport funding, NZTA are looking much more closely at the grant funding available for particular services. So you can expect through either public and active transport or through council further reports highlighting where there are some pressures with our grant funding, and that this council table will need to make some decisions about what we do with some of those services as we get closer to year end for things like total mobility and then potentially some of our standard services as well. So those things are still to come to the table, but potentially will have an impact on the numbers you're looking at now.
Okay, we can open it up for any questions that councillors might have. I can kick off if you want. Just looking at CapEx, Nick, the capital expenditure report under the ORC property operational, the variance from the forecast was for 1.5 million. The budget is 4,050,000. Now that's an underspend. Take it.
Yep.
What is that for? What's the cause for that?
There was two pieces in there. One was we'd provided some CapEx over over the 3 years of the LTP for doing more works through in Central Otago. And there's also an element in there of some other property spend that they'll do in relation to Whare Runaka, just for, you know, some bits and pieces. So they're the two things. We haven't done anything through in Central around what we might do there. You know, we are looking at the Queenstown office, and then there'll be fit out costs and different things. And we also factored into the LTP that we wanted to look at Central Otago, you know, and around Alex and Cromwell, and whether we'd do something there. So that's the bulk of the spend is in relation to that, and it's really just timing. We sort of just spread it over the 3 years of the LTP. I think we had quite a bit of it in year 1 and year 2. Reality is that it's that sort of cost is always reserve funded out of the asset replacement reserve, and that we'll deficit fund it from the reserve, and then the depreciation on those fit outs and everything will repay it over time. So that's what's going on there.
Just the next one down on that, obviously Whare Runaka
Yep.
is an interesting one. So we're showing a negative variance and overspend forecast for the end of this financial year.
Yep. So we had Whare Runaka, we actually had, that's the 5.6 million is half of that 11.2 million, which is our, you know, our fit out costs as part of the construction contract. So we actually had that spread last financial year and this financial year, 5.6 million. But we didn't pay anything last year. So last year we hadn't paid it. This has been funded out of the building reserve. So again, it still just sitting there. Yeah, and then what we've done is the 6.8 is the amount that we're just currently in the process of making an instalment payment for our share of what the port's been funding the full construction contract. And that just ties up with the amount that that they are paying us for the sale of Birch Kitchener, which is actually settling tomorrow. So it means that they don't have to go out and borrow more money to give us money for Birch Kitchener, and then effectively we're just giving it back as the instalment for this. So what will happen is whether there'll be another instalment before 30 June, we'll still wait and see. But at this point, that's the only payment that we've been invoiced for to date this year, and then that variance will flow through, sit in the building reserve, and we'll get the remainder of that 11.2 more than likely, you know, later this calendar year.
So in terms of the construction and the project cost to date, is it on target? Or are we seeing an overspend or an underspend on it?
Well, the port covers the overall construction. I mean, they're managing all of that. Our share, the 11.2, is still that, you know, there's no change to that.
Any questions from you, Derek?
While the port cover the capital cost, the lease cost will go up if the capital cost goes up, right?
No, because we'd agreed with them effectively a fixed price on the construction on the construction. So they were going to effectively, any budget overrun was going to be on their cost.
So they will absorb it.
Yeah. So effectively what they'd end up with is a slightly lower return than what they'd envisaged. Because the rent was going to be set at 6% of that budget cost. If the budget cost the actual cost was actually slightly higher and we're still paying it on the budget cost, the return might drop to, you know, 5 point something.
Now, just remind that the agreement for that arrangements, budget cost was for how many years before we do a recalculation?
I'd have to go have a look. It's at least 3. Yeah. It's got a market review. It's at least 3. It might have been 5, but be on the safe side, I'd say 3.
So at that point, Derek.
It'll be registered anyway. Yeah.
Thank you. Okay, Michael, you've got a question.
So can you just clarify for me on that? We've paid $11.2 million in the fit out cost for Whare Runaka. Yeah.
No, we haven't.
We haven't.
where that's how much our agreed share will be in total.
Yeah. How much have you paid of that?
That we actually, as of today, we haven't paid anything. As of tomorrow, we will have paid 6.87 million.
And when's the other due, sorry?
Well, to be determined.
Why?
Likely end of this calendar year.
Yeah, on the timing of when it's done.
Because the port is effectively funding that and cash flowing it. So, you know, it just so happens that for this instalment, we've timed it with the sale of Birch Kitchener, because it works out that we do a cash, you know, there's no cash that either of us have to draw down to make our payments.
So we got $6.87 million from the sale of it.
No, we got 7.9 million. 7.9 million is GST inclusive. 6.8 million 87 is GST exclusive.
Right, and that's what you're going to then give over. And they just remind me of the annual rent again, is it $2.6 million?
Yeah, 2.592, I think is the exact number, but yeah, 2.6.
And just also remind me of when we're moving up.
Yep, so scheduled to be moving in at the start of next calendar year.
After the election.
Yes.
We will not.
Thank you.
Okay, couple of other questions about Stephen and then Andrew.
Me, is it me now? Is it?
Yeah, you can go first if you can.
No,
You don't have anything. Yeah, go for
I'm
it.
just taking the mic off him. I was mic manager.
Sorry, hey, I was just looking at the rates revenue year to date, and you know how we introduced a mechanism to allow monthly payments, etc. And I just wondered, and looking at the numbers, they look to be on a par with what we budgeted. So do I just assume that having those additional payment methods, it hasn't really impacted on the volume of rates coming in? I appreciate there's been a rate increase for this current financial year, but did you want to expand on that?
Sarah would be better to talk about that. But what you see in the statement of comprehensive revenue and expenses is the revenue. It's not the cash flow of rates. So what we do is we take the budget and effectively we just release it to revenue on an even basis. So you're seeing half of the annual rates coming through as revenue, because that's all we do. But from a cash flow point of view, the actual cash flow will sit in the balance sheet where we actually receive all of it, and a big chunk of that will be sitting there as a liability, and then as we release it back in. Yep.
Gotcha.
But we've got the total. We record only the total amount as revenue in the screen.
Thank you.
Like if we can just go back to the CapEx report, I mean, I was just looking at the variances that are reasonably significant for the forecast at the end of the year. And we've got under the regional leadership, river management, safety and resilience, river management for Dunedin, which is going to be underspent by 1.2 million. Can you add anything further to what that variance is about, what's caused it? Obviously, there's no work being done, but
I can't. Tom's not here. I don't know if Sean's online. I don't know if he's got if he knows off the top of his head what the because the biggest one, well, there's two. There's Lower Taieri flood protection and the and river management Dunedin.
Page 15, it's got a whole lot of those numbers.
Do you know the reason for those forecast variances? They are underspent year to date, so I think there's it reflects that underspend's going to continue. But have you got any comment, Sean?
Yeah, there's a provision in the budget for some contribution towards, I think it's Leith Lindsay bridge repair work or something like that. I have had some discussion with Brett and Tom about whether that's going ahead or not. So it's unsure what's exactly going to happen there. It's an agreement, a past agreement.
So I can say that that's good, Sean, that's just reminded me what it is. So, and I will look back with Tom and just double check, but we had an agreement to fund a replacement bridge across the Lindsay, somewhere up in the north end. We've been waiting for that agreement to be given effect. So it's been sitting in the budget for some time. You might remember it in the infrastructure strategy. So whether this forecast reflects it, we might not be confident it will still happen this year. I know they were pushing to get that through. And it may be if we get that through that corrects itself by year end, but I will just get time to look back. But I would suggest that's the reason for the bulk of that.
Okay, thank you. Any further questions from council? I can keep going if you want. There you go.
No,
Yeah, okay, right. So just in terms, just rolling through to the report, council year to date by activities, regional leadership, environment, safety and resilience, transport, which are our performance and activity areas. Nick, the one thing that's changed with these reports is we're not seeing either the deficit or the surplus rolling through, sort of carried through. And particularly, I guess the one that's of most interest is transport, because we're rating above our costs for transport at the moment in order to make up the deficit that's been carrying forward. So just interested to know what that figure is at the moment, with the surplus rating that we've got. Hopefully you've got that figure on here.
So you're looking at page 16, the transport summary.
I was actually looking at page 12, which is the summary of all those activities, but yes, in more detail, that's right. 16.
Yeah, 16 has a bit more breakdown. But you can, I mean, in answer to the thing about that, it's got overall transport, so it's not just the two TT networks. It's also got PT other in there, which is largely total mobility. But you can see a year-to-date variance across the transport activities. So the 5 of them is that we're actually 1.2 million ahead year-to-date.
Yeah.
We've got that forecast to be pulling back slightly.
Yeah, I guess
by
that's not where I'm going.
700.
Oh, yeah, that's our current situation in terms of this quarter and this financial year. But I was
Yeah.
just wondering about the carry forward amount. That is actually being
2 million going to reserves.
Yeah.
In theory, the year to date, because we're rating an additional $2 million across Dunedin and Wakatipu to pay back the surpluses.
That's right. And over the next 5 years.
Over the next 5 years.
Right.
So in theory, that variance for year to date should be the $2 million, and it's lower because in our forecast we've got some additional spend, and then we're not 100% sure about the NZTA position on the grant funding. But like I said, we need to do some more work to get the certainty around that. We do treat the two buckets differently. So the surplus that or the additional that we're rating to repay the historic deficits, those historic deficits are, if you like, in a separate bucket, and we're monitoring that we take the rating money and that those balances will come down to zero until they're clear.
So that's the point that I'm getting at.
Yep.
The historic surpluses or deficits rolling forward don't seem to be evident in these new report formats that we've got.
Well, because this is just the P&L, if you like. So this gives us the surplus. I mean, once it's there, where it goes to, but what we've actually got is, based on this forecast, $2 million. There's a $2 million surplus that we'd forecast that is going to come off the historic balances. And then we've got, if you like, a new balance for this year that we were fully funding our operating expenditure. But if you take the 2 million off, it looks like we're going to be short potentially because of our grant revenue. if that's the case, then we're creating, if you like, a new operating deficit. And that's what we'll have to look at, once we've got a bit more certainty on what's happening this year, and then whether or not we're going to have to look to recover that, because ideally we're hoping that we won't, but yeah, we've still got a bit more work to do around
What
that
might be helpful
forecast
with these
position.
reports is, for these activity areas like transport, is to have at the bottom a carry forward surplus or deficit from
Yeah.
the previous year.
I think what you're sort of
Certainly.
saying is within those two networks, it would be useful to show here's how much of that revenue is just being used for the deficits, and then, if you like, the current year.
Yeah.
You know, so the current year operating versus what's.
Yeah, two
what-
lines.
Yeah,
Two
yeah,
separate
so,
lines.
so we can do a bit more analysis.
We can take it
on that.
offline and have
Yeah.
a look at it, but I think
Yeah.
it'd be helpful to have those historical figures surpluses.
Yep.
Just shown at the bottom of the
Yep.
reports. So, Kate.
Look, thank you for that discussion. You almost covered off what I was going to ask. I think we have to be really careful when we're talking about this, and we had a number of questions yesterday, not understanding the surplus. It was actually repayment of reserves, which I would have said are a deficit. And I think if we start having some consistent language, and God forbid I never did an accounting paper at school at RC, thank God, we're mixing up what is accounting terms with how do we translate openly and transparently what the money is going to. And I think sometimes we should be really clear that we're running a surplus to pay deficits, not reserves. And I think most people think of reserves as being a positive thing rather than a negative. When you go offline, can we think about the language we use to explain this so that it becomes consistent?
Yeah.
Um,
So
yeah.
if we can record in the minutes that we've got an action that comes out of this,
Yeah.
and that's to look at these carry forward historical surpluses or deficits at the beginning. Thank you.
And that I think would be helpful to translate into river management as well.
It's good. Yeah, Kieran.
Thanks. Just on regulatory, we're showing quite a surplus under regulatory, and we're saying that it's
Page.
additional.
Page.
Page 7 of 29. So it's 0.10 under actual year to date, 650K. I thought the comment was made yesterday that fees and revenue charges were largely cost neutral because of the staff cost associated with them. Whereas this number here is showing as a true surplus. And we're now going out to consultation looking to increase fees again.
Yeah, the consent revenue, there's even within consents, there's two parts to it. There's a fees and charges processing part, and there's a general other cost and administration part. Yeah. So the cost that we put into the processing is 100% recovered by fees and charges, and that's all that it's doing. But there's this other cost that, if they're doing more of this, then we're potentially not having more costs there, and in the, if you like, the non-fee charge portion of it. But their fee revenue is up on what we'd budgeted, but the fee revenue they can only ever recover in fees for the time that they put in there, and the fees are set so that they recover their time at actual cost. There's no margin in there. So although it might look that way, it's because there's other costs that's not happening, but that other cost is effectively was being rate funded anyway.
So then that line item shouldn't be there because this is just identifying the true surpluses.
But you look across, so you're looking at page 7, which has
Actual surplus
The actual surplus at 6 months.
So what, Carol, and I think Joe can jump in as well, but we, over the last, well, probably since I've been here, we've talked a lot about trying to correct the chargeable versus non-chargeable time, because obviously any time that staff are not spending on processing of consents is general rate funded, and our revenue policy, I think, might be 80-20, or it might be there or thereabouts, and we haven't been capturing the budgeted revenue from our cost recovered staff. So that's been an effort in both consents and compliance to ensure staff are focused on the cost recovered work, which is the core business. We budget an amount per staff member to collect through cost recovery, but it's also dependent on how many applications we get through the door. Because if the applications don't come through the door, then there's no work we can then charge for. So what that reflects is both increased applications over and above what we had budgeted for when we set the budget. So the staff and in some cases consultants have continued to process, and then we bill on an actual basis. It's just cost recovery. But also, so I'm looking at page 12, consents and compliance at the top line. And we've got a slight reduction in expenditure, which also just reflects the fact that we're not doing as much of the non-chargeable work or use of consultants to process as well. So it's been a concerted effort to try and ensure that team, or those teams, if we talk about consents and compliance, are meeting our revenue targets in terms of cost recovered, user pays versus general rate funded. But the over that you're looking at in 7, if we go back, is just a reflection of us billing for more work than what we had anticipated coming in with the staff levels that we had.
So you're saying that there's more economic activity over the last 12 months than
More consenting activity.
which is reflective of the strength of, and where is most of that coming from? I guess Central Otago.
Central Acts.
Yeah.
Yeah, so in the regional leadership, which is next month, there's our quarterly report now has that map, which will show you where the predominance in that consenting activity comes from. So we keep, this is one of the areas we keep a close eye on year, because I don't know, 3 or 4 years ago, we were running massive deficits in regulatory. So we don't want to swing the other way. We should be budgeting correctly, but I think the teams have done a really good job to ensure that they're focused on the core business, and we're reducing the general rate requirement. We're only staffing to levels that are appropriate for the work that we anticipate coming in. So I think we dropped maybe 5 consenting staff over the last 2 financial years because we knew that NES consenting was dropping away with the change in rules. So we are very conscious of it. But the fees and charges we set do need to reflect the actual cost of the staff time that is undertaking that work.
Which would be the community expectation.
That's right. That's right.
Okay, right, thank you.
Yeah, Michael?
Well, just as a sidelight to that, so I guess that explains the $1.3 million from Wakatipu Public Transport as well. Yeah. Is that activity has been greater there, more tourists in particular, more activity.
That's grant revenue.
Right.
Oh, well, there's a bit of a comment. They've got some that there's actually a bit of a change. We'd assumed in the budget that we were going to be contracting for the ferry services. So effectively, that would come on the same way we do the buses, and then you'd have gross cost and gross revenue, but we're not. We're just passing. It's still a net subsidy. So that's that changes the dynamic of how much we're paying.
So, sorry, can you just explain it to me again? There's a $1.3 million surplus there. Well, you're well ahead of revenue.
Just to clarify, Michael, is that both Dunedin and Whakatipu you're adding together?
No, just Dunedin's down.
Page
So
8.
Dunedin's lost money.
Page
Of
8,
course it's
okay,
lost money.
yeah, sorry.
Hang on, page 8.
But yeah, Wakatipu's made $1.3 million and over revenue, over the budget. So I'm just interested in the breakdown of that 1.3.
Yeah, and that is like we've got there that we're a big part of that is that we're forecasting additional grant revenue from Wakakotahi. Yeah, but we still need to work through that.
Is it a forecast? I thought that this was
The 1.3 is the forecast,
It's page,
which is on page 8.
is the forecast a year end.
The fees are up 370,000.
And page.
So there will be some more fair revenue, and there'll be more grant revenue is what we're forecasting. So they're actually year to date that network's up 550.
So will that change your estimates for, I suppose it will, for your for the annual plan, won't it?
We will look at it when we get closer to finalising the annual plan and we've got more certainty around where our forecast number was going to be. If we were really confident that we were going to be generating more and, you know, there'd be a surplus, then yeah, we could look at what we're rating for next year. But we haven't quite got there with that certainty yet.
The other deficit is IT. Is that because we didn't budget enough, or there has been something else that has come in that wasn't
Licenses.
foreseen?
A bit of that is we didn't budget enough. They've had additional license costs have come through. They've also had some additional depreciation that we didn't budget high enough for the depreciation on some of their previous costs. And part of that was when a little bit of it is an accounting treatment that when we went live with the new website, we had a balance on the remaining website, so we had to effectively write that off of fully depreciate it. So yeah, the 600,000, it's sort of a combination of all of those things are probably sort of roughly even. You know, our depreciation might be a little bit more than 200 and the website's a bit less. Subscriptions, all the license fees are, you know, is costing sort of an extra couple of 100,000.
So what's your annual budget for IT?
If you go to, I won't sort of guess. I'll go to page, page 17. Yep. So we've got there. Yeah, actually, I'd have to go away and break
Yeah, I
that
was gonna
down.
say-
I've got you got a net amount there because that's a that's not their gross spend because that's after they've allocated internal recoveries, which is that big credit up above it, and it's not that internal recoveries 15 million is not just them, it's across all of those costs. So I'd have to go away and I'd have to break that number down.
Sorry, one more. The 900K gain on investments, is that gain on investment return or is it gain on investment value?
It's gain on it's unrealized gains on the managed fund. So it's your effectively your share portfolio unrealized gain. Yep.
So it's not actually liquid available cash. It is.
Yeah, it is. I mean, you
Appreciation
know,
of
because we can
value.
liquidate. We can take money out of the managed fund. And so it's just that it's treated as other gains and losses because it's not cash. The managed fund actually by year to date December, the managed fund has gained about $2 million. So roughly $1 million of it is non-cash, i.e. the movement in the share prices, and the rest of it is cash and, you know, interest and dividends.
And then do we regularly draw down the managed fund?
No.
Yeah.
No, because we haven't got a cash requirement for it, but it's treated as income from a surplus deficit point of view. So we're counting all of that money as, you know, revenue for offsetting rates requirement. But there is a difference between what is cash and what is revenue for the purpose of calculating our surplus.
Exactly. Yes. And so that's the question is the 900K available cash? Or is it appreciation and value of the fund?
It's both.
Yeah,
In the sense that
it's just the fund value appreciating. But at any point, you know, we've got $29 million sitting in the fund.
Yeah.
If we decided we wanted $1 million in cash.
Then I thought your answer before was, but we don't draw it down.
No, we don't. We're in the time that I've been here, we've drawn down some money out of the managed fund once. Yeah. Yeah, when we did have a cash flow requirement, but because it was rather than going to the bank and getting overdraft funding, we were just slightly short before the rates came in. Now what we do is, like, when rates this year, the amount that we need is much bigger to cash flow that period where we start to run short of until our rates money comes in. We just go and borrow short-term funding from the LGFA, which we did over sort of between June and early November. We paid it back. We borrowed $15 million this year, but we can borrow that money through the LGFA far more effectively and cheaper than drawing money, and we can't, with the managed fund, to rebalance it and everything. You can't draw that sort of money out and then put it back in at that turn. We did, and it was probably 3, 4, 5 years ago when we were only going to be sort of $1 million short. We did that, but we could, at this point, we've just been accumulating the gains and the returns. We could look at a regular drawdown but
No, I'm not suggesting that
Yeah.
we should. It's shown here as what are relatively cash ups and downs. And so that was my question.
Yeah, they're all cash ups and downs until you get to that below operating expenditure. That other gains and losses is non-cash, which is why it's down there. There is non-cash still above in the operating expenditure because you've got depreciation, which isn't a cash transaction. So, but the bulk of everything else is cash transactions.
We'll give you the opportunity to take us through the Treasury report shortly. Any other questions around operational expenditure or income? Because we could move on to the financial position. Okay, Nick, if you want to if we could have a look at the balance sheet, the statement of financial position, just give us a heads up on that.
I think the key thing to note there is probably right at the top is the cash line. You can see there we've got
we're on page 18.
Page 18. So this, as at 31 December, we had just over 31 million in cash and cash equivalents, and so that's a result of our rates having come in and being due on 31 October. And the other financial assets, that's a little bit further down in current assets, that 29 million, that's the managed fund. And within there, other things to note, we've got related party receivable, which is in current and non-current. That's our on lending to the port. And then when you go down into the liability side, you can see we've got borrowings in current and non-current, which is our total lending from the LGFA. And of course, that'll be higher than the related party receivable amounts, because the difference is our own lending, which is 25 million.
So just a note, I mean, total assets for the organisation over $1 billion. Of course, a big portion of that is the shares that we have in Port Otago that you can see there, valued at $732 million. Our debt to equity is pretty healthy. I'm not sure how that stacks up against other regional councils. Nick, have you got any idea?
I haven't looked at it in any detail, but all council, regional councils in particular, sort of typically would have a fairly similar picture. A lot of the regional councils, number of them actually are the same as us. They've got investments in the ports, so they've got that. They've got the equity value of that built up. If they haven't got that, some of them have, if they'd sold out of those assets or had done whatever, they're sitting on larger endowment funds or managed funds like we've got. But a lot of regional councils, have a very similar sort of balance sheet to what we've got.
Okay. Any questions on that? Just if we move on to page 19, and that's the Treasury report. We've given us a little bit of overview of that. Is there anything further you want to add there, Nick?
No, it's, it just gives a bit more breakdown. So it gives a breakdown of that cash. We did have some of that on term deposit at the end of the financial year. We give the breakdown of the managed fund. So by asset allocation, that information goes to audit and risk, but we just put it here so that we've got everything summarised in one place that covers our cash position, our managed fund, and then down the bottom we've got our borrowings, which you can see there the split of that total LGFA debt. 25 million is ours, 122 million is the port's. The port, we have the agreement that they can borrow up to 150 million. So they've still got a bit of headroom there. They had sort of by June they had paid back they had decreased. They had been up a little bit higher than even where they're at. They paid it down to June, but over this last quarter they drew down another 9 million. But I've still got what's that, sort of $28 million headroom there.
In terms of the managed fund, I noticed yesterday in that the Korowai report, they were suggesting that we take a bit more of a punt, take a bit more risk with their managed fund. And I think the opinion was that it's a very conservative investment fund that we have there. Is there any comment on that?
Yeah, I mean, I think it'd be better if we sort of came back and talked about that report separately. But when we did our treasury policy and SIPO, we looked at council's appetite for risk, and we landed on 50-50. I think they've focused on council's capacity for risk, and you could argue, yes, we could definitely, we've got the capacity to absorb more risk, but with that comes increased fluctuations in the balance. And I don't know that council's appetite and comfort and the public's comfort for that would be as great. And if you think back to when COVID came along, we had, I think the managed fund had a balance of 25 million. The way we've got it structured, and JB Ware did some good work to make sure that they rebalanced and moved us, as quickly as they could. But largely they'd already done, they had it sitting where it was, and you did just have to ride it out. But our managed fund dropped to, we didn't drop below 20 million. But it went down into the, almost to 20 million. Now, if we had a different allocation, we would have seen that drop below 20 million. And I don't know how comfortable council would have been if I had been sitting here going, our managed fund has dropped from 25 to 15 million, So we had a drop, but I think everybody was acceptable. It was acceptable at that level. So, but it's certainly something that we could discuss.
So do we have a work plan? At some stage we'll be looking at that.
Well, that's something that if we discuss further with audit and risk, and we had that the review done of where we're at with the portfolio, the managed fund performance. And there was some recommendations that came out of that they thought maybe we could slightly amend things. So we'll have that discussion through audit and risk. There'll be an audit and risk discussion, and then if the view there is that we should make some amendments to the SIPO and to asset allocations, then it'll those recommendations would come back through to council.
Fair enough. Kevin, did you have a question?
Oh, no, I just probably disagree with the Te Kara recommendation in that we are dealing with public money, and it did show out, and I thanks for reminding me of those figures, Nick. It showed out at when we did have a financial disaster around that COVID time that we suffered a less loss than most funds, and JB Ware's tested. I think we're due to put even that back out to tender soon, but we also, they're all measured against benchmarks and the fund's performing well. So we don't need to get another board of directors over top of that fund again. So that would only add additional costs. So we are dealing with public money. So it does pay to be conservative and ensure when hiccups happen. If you can remember, hiccup happened in 1987 and also in about 2008, 2009. If you can remember those, the conservative funds were least affected. So I don't think it's in a bad spot. But always should be reviewing it. Yeah.
Good. Any further questions? We'll, if not, we can wrap up this section. Thanks, Nick. Oh, we do. Yes, we do. We have to note that report. So,
David move.
thank you, Kate. Seconder, Andrew, thank you. So all those in favour?
Aye.
Can I just make a comment?
Sure, yeah.
Paragraphs 10 and 11 with those additional tables about actual surplus and forecast surplus. I'm not sure whether I've ever seen those in that format before, and I just want to pass on a bouquet, very readable. And yeah, so ideal.
Yeah.
But I might miss something.
No, there was a change, but it was last time. You just missed it last time.
Okay.
Nice.
Excellent. Okay, so all those in favour, please say aye.
Aye.
Against? That's great, thank you. Mike, it's your turn.
Buddy.
I'm going to stay with you. No, I'm going to go to you.
Okay. So Q2, LTP measures and targets. So just to clarify the report that was in the CE's report yesterday, that was for period 7, so it's the end of January. This is to the end of December, so this is a quarterly that we program every quarter. Importantly, the traffic lights are identical for both of those reports. So if you've read that P7, you can have comfort that this Q2 report here is identical. This obviously has the commentary around it. So we'll go from there. I think we should just drop into page 25, and I'll give you just a quick flyover of the changes that have occurred across the business from Q1 to now. So looking at that table, that graph there, chart graph, you're looking at an additional red. So there's reporting 3 will not be achieved. It was 2 in Q1. The additional one is around passenger transport percentage punctuality target. You recall we talked about that yesterday. So that's changed. With regard to the at-risk, the yellow reported targets, that's shifted from 4 to 7. And there's a bit of a net effect going on there, but it looks like 4 changes in yellow for Q2, and they relate to the air strategy and the regional air plan. They're 2 integrated, separate, but albeit integrated programs, and there's a bit of alignment there. So that's why they're there together. There's natural hazards and climate change, and that's around the South Dunedin Futures program. And there's there's just some revision around that work program that's come in. And the final 4th one is around river management and just communicating our issues to affected landowners within the 20 days. And there's 3 communications that we haven't met that 20-day period out of quite a big number. So, but we'll work through the detail, and you can just focus on what you want to. So that's the flyover. I'd suggest through the chair that perhaps we step through the detail beneath. If there's any questions at this point.
Questions?
Yep.
It's good summary.
Okay, Kevin. Yeah.
On the getting back to people after the flood, and you said there was just a couple out of many that you didn't get back to. Is that around getting back to with a solution, or just getting back to say, we understand you've got a problem and we're working on it?
Yeah, I'm not over.
Right, so which is two different parts to it. If I could understand if the solution is taking a bit longer, and we haven't got back to the solution, but we should still probably be saying to them.
Tom's on the way, but I can offer, so the target is reported issues that have been investigated and appropriate action determined and communicated, so it's not done.
Yeah,
But they have gone out and they've assessed it and they've gone back, and that might be to say we need to do further investigation, or it might be to say we've seen it and it's a small job and we'll program it. So that's the measure, and that's within 20 working days of the report.
right.
So the challenge, obviously, when we have a massive weather event, is just purely a capacity issue, and we try to at least get in touch with everyone. We may just not have completely met that target, because we might not have been able to do a physical inspection or be able to get that solution through.
Yeah, and so that's the key part, that the breakdown that I reckon is the critical part, because if you may not have come back to me with a solution, but I'm really happy with your communication because you're telling me that.
Yeah.
So there's a subtle difference there.
There is.
Yeah, and
The auditors don't appreciate subtle differences. The auditors don't appreciate.
Well, I don't really care because I do, because I've got a little bit. Yeah, but if you know what I mean.
Yeah,
That's
and the river management team will be able to provide you that report and more breakdown. We're obviously just reporting against
that's cool.
measure.
Yeah.
But they've got the data in terms of when people responded to and how long that took and where we might have missed anything.
Yeah, and it might be just waiting on an engineer's report to say that's the best solution.
That's it.
Yeah, but it's communicated to the person's happy.
Yeah.
All right, and then the other one, sorry, can I have one more?
Yeah, go for it.
Hey, on the, and I knew I did read it, so we're looking at changing our punctuality measure from 95% on transport, from 95% down to 90% because of all the hiccups that we're having. But when you look at the actual figures, we're not far from 90% anyway, which is 87 and 90%. Under transport activity, Dunedin was 87 and Queenstown was 89. So again, I don't know where that got to yesterday, but I'm still saying it should be at 95% because at 87 and 89, with all those hiccups you've had, you're still going pretty close to actually getting. I think 90 is too close. Yeah, but I think on buses, punctuality is absolutely key, and if we're not at 95% or heading to 95%, where it's going to affect things.
Yeah, that's definitely something that you can decide in deliberations through in your plan. And
that comes through deliberations, Mike.
Yes,
That's what I need to know.
You'll set that new target, and it might be the same or whatever you decide.
Yeah, good. Thank you.
So that's May.
Good.
Any further questions on these points? So it's a good report. I think despite some people not liking traffic lights, I think it's quite informative. I had a question yesterday that I've actually been able to answer by just reading this report. And that was around the 12-hour RCD workshops. I see we've delivered 15, so we've overachieved here. So very good.
Shut the morning tea.
Yeah. Anything further?
Good move.
Okay, thank you, Kate. So we'll
Happy to second.
move that this report is noted. So did I have a second? That was Kevin.
Yep.
Yeah, all those in favour, please say aye.
Aye.
Okay, thanks. Nita, yeah.
Thanks. I just wanted to finish today's finance meeting by recognising Mike. So Mike will be leaving the ORC on the 14th of March, is his last day. And I just thought it was really appropriate to recognise his significant contribution over the last 7 years. The work he's led to deliver our quarterly reporting, to deliver our annual plans, our corporate plans, our long-term plans, and really put us in a really good position on all of that. He's built a lot of trust and confidence around this table, and internally and staff, internally with staff as well. So just wanted to say thank you to Mike on the record, and let councillors know as well.
Yeah, and from our side as well, thank you, Mike. 7 years is a good start. It's sort of about ideal, I reckon, because
No.
you can, well, in a way, you're all refreshed up until that 7th year, perhaps, and then you need quite something else.
7 year itch.
7 years. Is that some advice on councillors?
Could be. But, no, thank you very much, Mike.
And
Really appreciate the work you've done, and particularly leading us through our planning. It's been good. So good luck with your next steps.
thank you. It's look, April 2018, and Gary actually reminded me yesterday when he was talking about change. It's been a heck of a learning curve for me, and it's more of an experience actually being in an organisation that has transformed and changed so much over really a short period of time, in terms of its scale, and all at the same time where there's some massive issues going on in the region around water. What an interesting time to be here. And I think I'll just keep reflecting on that. Actually, there's a lot of learning came out of it. And hey, look, elections. I wish those, all of you that stand, the best of luck. Yeah, thanks.
Thanks very much.
I've overlapped with Mike, several councils, and I'm not saying that, but Mike is such a dependable, reliable, safe pair of hands as the manager of corporate planning, and I think that ORC's been lucky to have him, and other TAs have been lucky to have him over the years as well. So yeah, all the best, mate.
Yeah, look, having been in finance and ordinance right through this period with you and coming in new, what the thing that I've read, reliable, dependable, but adaptable, and how we've changed our systems from our first long-term plan we did when I first started to this last one, and going through the whole process. Well done, Mike. So, and all the best for whatever you do. So, no, it's been a pleasure. Thank you.
Good right. And with that, we'll declare this meeting closed, and we are moving into a council non-public.
Yeah, so we'll just take 5 minutes to grab a cup of coffee, and then we'll pick up where we left off from council yesterday with that one.